Remember, we've seen an uptick in sentiment in IT stocks, and the stocks are also trading at record highs. But Sandip Agarwal, fund manager and co-founder of Sowilo Investment Manager, joins in. Hi, Sandip. Thank you very much for joining us this morning. We are at the end of 2024, which has been a pretty interesting year, to say the least. Talking about IT stocks specifically, there's been a significant uptick in the sentiment in IT stocks and the stock prices also. Quite a few of them are trading at record highs since the US election. Is this likely to convert into earnings?
Hi, good morning, and thanks for having me on the show. So, if I answer your question, which is the crux, basically, yes, if the tax rate, corporate tax rates goes down in US, and that will lead to increase in corporate earnings. So there'll be two benefits. One, sentimentally, companies will be more open to spend on technology, and second, they will also have more money to spend. So both the things are positive, but at the same time, remember that we are right now only looking at the positives of corporate tax rate cut and all those things. Between 2016 onwards, we have seen that whenever demand has been good and profits are good, we have also seen some kind of cost increase which has come for Indian IT in terms of increase in local talent and all those things. So I think right now everyone is seeing one side of the story, that yes, US will recover, there will be corporate tax cut, but at the same time, remember, because we are servicing those market, there could be some cost of doing business which can come along with it. So that is what I see, and I think that last 1 year has been very, very good for the sector. And from here, while numbers will improve substantially in my view, but I don't know how much multiple re-rating can happen. So we can see actually some time correction.
You make a good point. When we see those tariff hikes and we see tax cuts, there will be more money to spend for these corporates, right? So discretionary spending will go up. But let's just rewind to the quarter earnings. Numbers were disappointing. In fact, for most IT companies, revenue was witnessing a slowdown. Best case moderate, worst case slow. And this is because the deal inflow from Europe and the US was looking weak. I'm assuming you've talked to a few corporates over the last couple of months. While the anticipation was that the uncertainty of the US elections, once behind us, deal flows will pick up. Do you see that happen already? Is it already underway? Because if not, then we are talking about 2 to 3 quarters out till we actually see an improvement in top line for some of these IT companies, right?
So let me put it this way, that this is the season when, by 12th of January, most of the clients in the US and all and the developed markets will freeze their budget, what they want to spend in the next calendar year. So I think everyone is undergoing that process, but I can tell you with my 2 decades of experience that when the things start looking better, particularly in the US market, where you start seeing that, this kind of delta in profits of the enterprises will come, then the discretionary spends actually go up. So I would say that you will see good deal flows, and I believe that deal flows has not been so bad even in last few quarters, except for some misses from Europe. So I think deal flows will be good. Conversion to revenue will start from first quarter of next year, in my view. But at the same time, there will be some cost of doing business which will definitely be implemented, in my view, because Trump is very smart and very hard negotiator. So he will not give an easy run to our companies as well. That is what my sense is.
Sandeep, good morning. Niraj here. In the event that the inflation numbers in US are higher in 2025 because of tariffs or otherwise, and therefore there is a unanticipated hike or a set of rate hikes in the US, what happens to valuation multiples of IT businesses worldwide and in India too?
Yeah, so a very good question, honestly. So, always we have seen that when rate hikes happen, then finally everyone is doing a DCF in an indirect way. Means even the price earning multiple you derive is basically a reverse calculation for your DCF. So if your cost of equity is going to go up, then obviously the multiples will come down. The only thing which is little differentiating in Indian IT sector is that we always benefit from good of both the places. We benefit from scale and cost saving from India, and we benefit that our end clients are in US. So it has never happened that from both the sides we have been at a receiving end. Very rarely does that happen. in my view, if you see last 2-3 years, even the interest rate arbitrage has come down substantially between US and India. So I would say that even if there is a rate hike, the proportion of rate hike may not be similar in India. Maybe we will see a flattish, or we may even see our rates being getting cut. So to that extent, investors will be in a situation where they will not be very clear whether to discount it on Indian rates or whether to discount it on US rate, because this is a long debate I have been facing when I was as an analyst also for 2 decades almost, that some of the investors wanted to discount it with US weighted average cost of capital, and some investor wanted to discount it with Indian weighted average cost of capital. So very hard to call, but interest rate going up is not sentimentally positive.
Okay. Now, traditionally people find favor with large cap in times of extreme valuations, but a lot of non-Nifty IT companies are also large in nature, Sandip. They are not, I mean, you can argue they are mid caps, but traditionally they are not mid caps with market caps of over 40,000 crores, right? I mean, under SEBI parlance, whatever, but 40,000 crores market cap is a large liquid name, good enough for a large fund manager as well to deploy. So my question to you is, when you look out at 2025 or maybe say FY26 and 27 earnings and try and project and then try and think of where is it that the growth versus valuation combined looks the most attractive, what stands out? What's been a part of your portfolio? If you can talk about specifics, if you can't, then give us a flavor of what nature of IT stocks do you like?
So, Niraj, I always invest on two parameters. One is that, I believe that in Indian IT services, whenever there is a lot of negative news, that is the time to buy the large Indian IT stocks, and you make 30-40% in next 12 months, because this is the business which has a very incredible strength. 96% of the global outsourcing market is actually with India if you deduct the BPO businesses from the denominator. Even if you include that, we have 76% of the market share. So which means that the strengths are immense, and I have tracked every country which has tech talent, and I can tell you with a lot of data that no one can execute like India at that scale and at that price. So this business will remain with India for a long time. I don't think it will be easy to crack. The scale of engineering students passing out, the salary levels and everything is incredible. So we love IT services at a structural bit, but at a valuation, because see, this sector is very matured. 20% of outsourcing in US has already happened. So in my view, this is a sector where, whenever there is extreme pessimism, when variable pays are cut, where wage hikes are postponed, which happened last August, September, that time, no one was willing to see at the sector. And we were continuously, when we interacted with you also, I was saying that this is the bottom. And from there, it has run up quite a bit. And now I think it is on the other end where everything is discounted. Now, God knows, only means maybe, something totally different can justify this kind of numbers. So we are now looking at one or two names in the large cap which are reasonably priced, but otherwise thematically we are very positive on the ER&D space, because ER&D space should grow at 2.5 times of the IT services space. Although in ER&D, because it is growing faster and some of the companies fall in that bracket which you mentioned of 40,000 crore, the multiples are very high. So we prefer to buy these stocks when there is bad news for 1 or 2 quarters, and then we try to hold on to them, because we are looking at them as from a 10-year perspective. So that is the way we are building our portfolio. So the IT services large cap is more of a positional bet, and the ER&D long term is more of a structural bet.
You want to give us specifics that you are positionally investing in the large cap space, and which is your favorite ER&D company?
So I will not be able to name any specific company, but I will tell you that, within the ER&D, Persistent, LTTS, Data Elixir, KPIT, these are all good names. And within IT services, some of them are there which has a shade of ER&D and product engineering combined. So those are also quite interesting, like Coforge. And then there are large caps like HCL Tech, which has both product engineering, some portion of ER&D and some portion of digital also. And Tech Mahindra, where telecom has not spent for a long time, and I believe that telecom capex will open up at some point of time, and the metrics are in its favor. So these are the names which are looking good to us.
Noted. Okay, Sandip, appreciate you joining in and giving us your sense of the space. Thanks so much for taking the time out and giving us your thoughts.